In this presentation, we will discuss the credit for the elderly or the disabled. This will be a fairly long presentation, so if you'd like to jump to relevant points within it, go down to the description below and you'll see some descriptions of those relevant points and a hyperlink that will take you directly to that point within the presentation. Most of this information is drawn from publication 524. Go to that publication for more information about it. We'll go into some of the requirements for the credit and we'll give some examples of the calculations and the forms that will be used using tax software. Note as we go into this credit, it is a credit that's going to be fairly limited in many different situations by, amongst other things, an income limitation, adjusted gross income limitation. In this presentation, we will discuss the question of, are you eligible for the credit for the elderly or the disabled? This information will be coming from publication, Are You Eligible for the Credit? You can take the credit for the elderly or the disabled if you meet both the following requirements. 1, you are a qualified individual. 2, your income isn't more than certain limits. We will talk about these two requirements in more depth in future presentations. Here is our test 1040 with a simple single individual. As we scroll down, we have our information. We have the $15,000 of income in this sample file. We're going to say that the $13,600 is the standard deduction, higher than the $12,000 because of the qualifications of our taxpayer, including the age of the taxpayer. We're going to say that the difference then between those two is $1,400. $1,400 being the taxable income. The tax is at $141 then, and we're concentrating here then on line 12. So line 12 is going to be our credit. We see it here on line 12. We'll also see it calculated by the software on Schedule 3. So Schedule 3, line 54, other credits from form. This one from Schedule R, that 141. And then we'll go to Schedule R, where we will see an example of the actual credit, the credit for elderly and disabled. We'll go into a little bit more detail on this later, but in essence, we have the single head of household or qualified widow, widower. Were you 65 or older? In our case, we're saying yes, 65 or older. We see similar kind of boxes if married filing joint, married filing separately. We'll go through the actual calculations in a bit more detail as we go, but if we scroll down here, we're going to see the calculations. We'll examine this in more depth in future presentations, and we get down to the final number on line 22, which is the 141. One of the limitations we can see is the tax liability, which was 141, and then that 141 was what was pulled over to the Schedule 3, and that's going to be pulled over to the Form 1040. So this is just to get an idea, an overview of the process, what we're going to be needing in order to process this from the tax software standpoint. We'll typically need the Schedule R. The Schedule R is going to go through the calculation, and we have 2 pages on the Schedule R. Once we have that calculation, we need Schedule 3, which is kind of new for the 1040. Remember last year, you might have had a 1040A or 1040EZ. This time we just have a 1040, but then we have these added schedules. So these added schedules, it's probably a better way to do it because then there's only one 1040 to start with, and then we add on schedules as needed. So in this case, we got Schedule 3 that we'll add on, and that's going to be the non-refundable credits. And that means it's not going to be a credit that takes you below zero. It's not going to result in a refund if there were no taxes. And then that amount is going to pull over to the 1040, and the line 12 is usually where we sum up basically all the credits that are non-refundable, as opposed to the refundable credits that would be down here in around line 17. In this presentation, we will discuss the term of a qualified individual with regard to credit for the elderly or the disabled. Qualified individual. You are a qualified individual for this credit if you are a U.S. citizen or resident alien, and either of the following applies. 1, you were age 65 or older at the end of 2018. 2, you were under age 65 at the end of 2018, and all 3 of the following statements are true. So in other words, you were 65 or older, that would be the condition. If you were not 65, but then had all 3 of these conditions met, then we would be here in the second step. So all 3 conditions, including A, you retired on permanent and total disability, explained later. You received taxable disability income for 2018 on January 1st, 2018. you had not reached mandatory retirement age defined later under disability income. So we'll discuss the method 2 in a bit more detail later on. But of course, the standard qualified individual would typically be in step 1 here, where you age 65 or older at the end of 2018. Back to the text. Age 65. You are considered to be age 65 on the day before your 65th birthday. As a result, if you were born on January 1st, 2054, you were considered to be 65 at the end of 2018. Death of taxpayer. If you are preparing a return for someone who died in 2018, consider the taxpayer to be age 65 at the end of 2018 if he or she was age 65 or older at the time of death. Note, a person is considered to reach age 65 on the day before his or her 65th birthday. For example, if the taxpayer was born on February 14th, 1953 and died on February 13th, 2018, the taxpayer is considered age 65 at the time of death. However, if the taxpayer died on February 12th, 2018, the taxpayer isn't considered 65 at the time of death or at the end of the year. So this is a kind of an unusual situation. They're basically saying if they would have reached 65 at that year but didn't quite get there and died in the middle of the year, but they weren't 65, then they wouldn't be 65 and therefore not qualified. However, if they reached that age and then died during the middle of the year, would still be qualified for the tax credit, or a qualified individual at least. Let's take a look at our test 1040 with our simple single individual and test some of these age tests. So we have to be 65. The example was that we were considered to be 65 on the day before the birthday. So the example given that would be on the cutoff, if we say that our individual was born on January 1st, 1954, then it would assume that the birthday was the day before that, December 31st, 1953. And if we go back up, we're going to say that we should be, it's actually calculating the credit. So if we go to Schedule 3, we can see the credit is being calculated with this form. If I change the date, if I say, okay, well, what if we change this to 1 day later and say that this is going to be on January 2nd, which they would say that it would be January 1st then, that would be the counting date on according to the regs. Then we're going to go, or the instructions, the publication, we're going to go back to our forms, and you'll note that the software basically disappears and no longer is calculating the credit. Again, the software, whatever the software does, doesn't mean that that's the way the tax code is, but the software is, of course, built based on the tax code. So we can kind of use the software and how they programmed it to give us some idea of the regulations and give us some kind of verification or some checks in terms of how the software reacts with regard to the regulations we're looking at. Next, we'll test a taxpayer that died in 2018 and was going to reach basically 65 at the point of 2018. And basically, they're saying that if they were reached 65 in 2018, then they would be a qualified individual. And if they hadn't yet reached 65 but would have in 2018 but didn't get there before death, then they're not going to get the tax credit. So let's just see how that would work. They have an example of 214, if the date of birth was February 14th, 1953, and the date of death was February 13th, 2018, we're going to say go up to our forms and see if they calculate the credit, and you'll note that we have the Schedule R being calculated, and the system's going to say that 65 was reached then, is the assumption here, and therefore the credit is then calculated. And then if we change the date and we say, okay, well, what if the date of death was the 12th, 1 day earlier, still would have reached 65 in 2018, but didn't quite get there. And then we're going to say that, go back here and you'll see that the system kicks it out and says it's not recording that, which of course is the assumption is that it's not doing that because they did not reach 65 in 2018 or before the point of death. In this presentation, we will take a look at the U.S. citizen or resident alien requirement with regard to the credit for elderly or the disabled. We can find this information in publication 524. U.S. citizen or resident alien. You must be a U.S. citizen or resident alien or be treated as a resident alien to take the credit. Generally, you can't take the credit if you were a non-resident alien at any time during the tax year. Exceptions. You may be able to take the credit if you are a non-resident alien who is married to a U.S. citizen or resident alien at the end of the tax year and you and your spouse choose to treat you as a U.S. resident alien. If you make that choice, both you and your spouse are taxed on your worldwide incomes. So in that scenario, note what they're saying here is basically if you make the choice to take your worldwide income, in essence, this is my paraphrasing of it, so I'm just paraphrasing here. If you take the income and choose to have your income be taxed in the U.S., then it's possible that you might have an exception. However, of course, a lot of times if we're not a U.S. citizen and we're being taxed somewhere else, then it's possibly that we don't have the tax being taken here, because then there would be some double taxation. And in the case where that's the case, of course, then you wouldn't have the credit as well. Back to the text. If you were a non-resident alien at the beginning of the year and a resident alien at the end of the year, and you were married to a U.S. citizen or resident alien at the end of the year, you may be able to choose to be treated as a U.S. resident alien for the entire year. In that case, you may be allowed to take the credit. For information on these choices, see Chapter 1 of Publication 519, U.S. Tax Guide for Aliens. So if this is an issue for you, you can probably find that on the irs.gov. You're looking for Publication Pub 519. In this presentation, we will discuss a taxpayer under the age 65 with regard to the credit for elderly or the disabled. We can find this information in Publication 524. Under age 65. If you are under age 65 at the end of 2018, you can qualify for the credit only if you are retired on permanent and total disability, discussed next, and have taxable disability income, discussed later on disability income. You are retired on permanent and total disability if. Let's go through that one more time. The normal qualification would be to be 65 or older. If not 65 or older, we have some exceptions. Let's go through that exception one more time. If you are under 65 at the end of 2018, you can qualify for the credit only if you are retired on permanent and total disability, discussed next, that's what we'll get into now, and have taxable disability, so note the and, not the or, and have taxable disability income, discussed later under disability income. You're retired on permanent and total disability if. So now we're looking at the definition of what it means to be retired under permanent and total disability. When would that qualification be? So you were permanently and totally disabled when you retired, and you retired on disability before the close of the tax year. So those are the conditions. Even if you didn't retire formally, you may be considered retired on disability when you have stopped working because of your disability. If you retired on disability before 1977 and weren't permanently and totally disabled at that time, you can qualify for the credit if you were permanently and totally disabled on January 1st, 1976 or January 1st, 1977. Tip: you are considered to be under age 65 at the end of 2018 if you were born after January 1st, 1954. So that's going to be basically the cutoff. Permanent and total disability. You have a permanent and total disability if you can't engage in any substantial gainful activity. So this is going to be the definition. Not being able to gainful activity is basically kind of work for money. Gainful typically means for the tax code working for money activity because of your physical or mental condition. A qualified physician must certify that the condition has lasted or can be expected to last continuously 12 months or more, or that the condition can be expected to result in death. So those would be the definitions. Substantial gainful activity. So now we'll define what does it mean to be substantial gainful activity, and more definition than I just gave there. So substantial gainful activity is the performance of significant duties over a reasonable period of time while working for pay. So that's kind of working for pay or profit, or in work generally done for pay or profit. Full-time work or part-time work done at your employer's convenience in a competitive work situation for at least the minimum wage conclusively shows that you are able to engage in substantial gainful activity. Note, information on minimum wage rates is available at, and so here's where you can find the information there. Substantial gainful activity isn't work you do to take care of yourself or your home. So note that what gainful activity is not, it's not work just to take care of yourself or your home. It isn't unpaid work on hobbies, institutional therapy or training, school attendance, clubs, social programs, and similar activities. So these things don't qualify or doesn't mean anything related to the gainful activity. However, we have the however here, the nature of the work you perform may show that you are able to engage in substantial gainful activity. So it's basically saying, obviously, if you're doing some type of work for pay, then you're engaging in gainful activity and you're competing in the marketplace, and therefore you'd have gainful activity. You'd be able to do that clearly. That would be proof, in essence, of that. And if these other activities aren't evidence of gainful activities, because they're not basically competing in the workplace for work and whatnot. However, the nature of the work you perform may show that you are able to engage in substantial gainful activity. So the fact that we're able to do some of these, and if we're able to do them well, you would think that would be evidence that we might be able to do gainful activity, compete basically in the market and whatnot. So that's my paraphrasing of it. Back to the text. The fact that you haven't worked or have been unemployed for some time isn't itself conclusive evidence that you can't engage in substantial gainful activity. So in other words, just the fact that we haven't, work itself, of course, if we were to be working in a gainful situation, would be evidence that we can do so because we are doing so. We're competing in that situation for work and whatnot. But the lack of work doesn't necessarily prove that we can't engage in gainful activity on the other side of things. Okay. Back to the text, the following examples illustrate the tests of substantial gainful activities. Example 1. Tricia, a sales clerk, retired on disability. She is 53 years old and now works as a full-time babysitter for the minimum wage. Even though Tricia is doing different work, she is able to do the duties of her new job in a full-time competitive work situation for the minimum wage. She can't take the credit because she is able to engage in substantial gainful activity. So she's still able to engage in that, so she can't take the credit because she's under the 63 and doesn't meet all the, she's under 65 and doesn't meet all the conditions that would be required because she can be gainfully employed. Example 2, Tom, a bookkeeper, retired on disability. He is 59 years old and now drives a truck for a charitable organization. He sets his own hours and isn't paid. Duties of his nature generally are performed for pay or profit. Some weeks he works 10 hours and some weeks he works 40 hours. Over the year, he averages 20 hours a week. The kind of work and his average hours per week conclusively show that Tom is able to engage in substantial gainful activities. This is true even though Tom isn't paid and he sets his own hours. He can't take the credit. So now they're saying, in this example, this situation, it looks like it's not direct proof that he is actually engaging in gainful activities because he's not in the marketplace getting paid. However, this is kind of that however situation. It seems that the engagement that he is doing is something that he could possibly compete in the market in and do for profit, and that's why that's my interpretation of why they're saying he can't take the credit in that case because of that evidence. Okay, example 3. John, who retired on disability, took a job with a former employer on a trial basis. The purpose of the job was to see if John could do the work. The trial period lasted for 6 months, during which John was paid the minimum wage. Because of John's disability, he was assigned only light duties and a non-productive make work nature. The activity was gainful because John was paid at least the minimum wage, but the activity wasn't substantial because his duties were non-productive. These facts don't, by themselves, show John is able to engage in substantial gainful activities. So in this situation, they're basically saying he may still qualify for the credit. This is my interpretation. May still qualify for the credit, even though actually working, getting paid, because it's in a trial period, and that trial period isn't really showing the full, what the job would actually do at full activity It's basically a test trial period and possibly the not performing at the level that would be necessary under normal gainful employment. Next example. Joanne, who retired on disability from a job as a bookkeeper, lives with her sister who manages several motel units. Joanne helps her sister for 1 or 2 hours a day by performing duties such as washing dishes, answering phones, registering guests, and bookkeeping. Joanne can select the time of day when she feels most fit to work. Work of this nature, performed off and on during the day at Joanne's convenience, is an activity of a substantial and gainful nature, even if she is paid for the work. The performance of these duties doesn't, of itself, show that Joanne is able to engage in substantial gainful activity. So they're basically saying that because of the nature of the work here, doesn't necessarily show substantial gainful activity and therefore may still qualify for the credit. Sheltered employment. Certain work offered at qualified locations to physically and mentally impaired persons is considered sheltered employment. These qualified locations include work centers that are certified by the Department of Labor, formerly referred to as sheltered workshops, hospitals and similar institutions, homebound programs, and Department of Veterans Affairs, VA, sponsored homes. Compared to commercial employment, pay is lower for sheltered employment. Therefore, one usually doesn't look for sheltered employment if he or she can get other employment. The fact that one has accepted sheltered employment isn't proof of the person's ability to engage in substantial gainful activity. So they're saying basically if you got work at the sheltered employment, it's below the normal market rate and therefore doesn't qualify for the gainful activity, and therefore because it does not qualify for the gainful activity, you may still qualify for the credit then, even if you have that sheltered work. Physician's statement. If you are under age 65, you must have your physician complete a statement certifying that you had a permanent and total disability on the date you retired. You can use the statement in the instructions for Schedule R. You don't have to file this statement with your Form 1040, but you must keep it in your records. So they're basically saying if you're under 65, one of the requirements is the permanent and totally disabled, and to get evidence of that, you would need that from the doctor to give the evidence of that. That evidence may not be provided on the 1040. That actual note may not be provided. However, if there was an audit, then we want to make sure that you have that information and just can provide it in the case of an audit. So veterans, if the Department of Veterans Affairs, VA, certifies that you have a permanent and total disability, you can substitute VA Form 210172, certification of permanent and total disability, for the physician's statement you are required to keep. VA Form 210172 must be signed by a person authorized by the VA to do so. You can get this form from your local VA regional office. In this presentation, we will take a look at income limits related to the credit for elderly and the disabled. To determine if you can claim the credit, you must consider 2 income limits. The first income limit is your adjusted gross income, your AGI. So the adjusted gross income can be found on the Form 1040. So this is an example of the Form 1040. That'll be on line 7. So line 7, we have the income information up top, total income, the adjusted gross income on line 7. That could be adjusted by above the line deductions, which would be on Schedule 1. We don't have any at this time. There would be the adjustments to income. Line 36 then could make that difference. And so the adjusted gross income is, of course, one of the standard type of numbers we use, oftentimes within the tax code is used in order to see if there's any kind of phase outs for the income, or whether we can get some type of tax or some type of credits. And that, of course, is here on line 7. Back to the text. The second limit is the amount of non-taxable Social Security and other non-taxable pensions, annuity, or disability income you received. The limits are shown in Table 1, which we will see shortly. If your AGI and your non-taxable pension, annuities, and disability income are less than the income limits, you may be able to claim the credit. See figuring the credit yourself later. We'll see that later. Caution, if your adjusted gross income or your non-taxable pension, annuities, and disability income are equal to or more than the income limits, you can't take the credit. So here's going to be the income limits. If your filing status is these, either single head of household or qualified widow, widower, married filing joint, and only one spouse qualifying in figure A, married filing jointly, both spouses qualifying in figure A, or married filing separately, and you lived apart from your spouse for all of 2018, then even if you qualify, you can't take the credit if your adjusted gross income, AGI, line 7, is equal to more than these amounts, or the total of your non-taxable Social Security and other non-taxable pension, annuities, or disability income is equal to or more than these amounts. So we'll just be taking a look at the first two. If we have the single head of household or qualifying widow, widower, we got the 17.5 AGI and versus married filing joint, in essence, the 20,000. And then we have the other income. This would be the Social Security and other non-taxable pensions, annuity, or disability, 5,000 limit, or 5,000 for both the single head of household and the married filing joint. So to test those, note we're on our test 1040. We have the single individual here. We can see that the income we're saying is just basically W-2 income, normal income here of the 15,000. So we've got the 15,000 of the income, and of course the credit is being taken. So we see the schedule here, credit being taken. If we raise that to the limit of the 17.5 and we say, all right, we have normal income of the 17.5, we're going to say 17.5, and then those items disappear, right? Because there's not going to be any credit at the 17.5 because that's going to be above the AGI limit, or it's going to hit the AGI limit. So the AGI line 7 is at the 17.5 for the single filer. If we take it down to 17,000 and see what will the software do there, we could see that it is still being calculated at that amount. So 17.5 being the limit. In this presentation, we will use tax software to analyze Schedule R, the calculation for the credit for the elderly or the disabled. We're going to start with our test 1040. We have a simple single individual. We're going to say that this individual is over 65 and it's going to be a qualified individual for this tax credit. We're going to say that the income is 15,000 and we have 500 of the Social Security benefits, and they're going to be non-taxable Social Security benefits. That'll give us the income of 15,000. We have the standard deduction because of the age and the filing status of the 13,600 to give us the taxable income of 1,400. That gives us a tax of only 141, and then we're concentrating here on line 12, which is going to be our credit, which is the 113 in this case. If we go to Schedule C, we'll see that Schedule R credit, and that's the 113. So now we'll go to Schedule R, and we'll just take a look at this form and see how it is put together. So this is Schedule R, credit for elderly or disabled. As we scroll down, we have Part 1, check the box for your filing status and age. We're going to go with the single filing status, and we're going to say you were 65 or older. So we're going to say check that box. And then we're going to keep going through, as opposed to married filing status, checking the appropriate box, married filing separately, and so on. Instructions then say, did you check box 1, 3, 7, or 8? If yes, which we did because we checked box 1, we're going to skip part 2 and complete part 3 on the back. So part 3, here's part 2. This is statement of permanent and totally disabled. We're not going to go to 2. We're going to go to part 3 here. And so we go to page 2, which is part 3, where we actually figure the credit. So figure the credit, we had box 1, 2, 4, or 7. We had box 1, you'll recall, that was that box we checked off, 5,000. So we're going to pick the 5,000 according to this table. Then it says, did you check box 2, 4, 5, 6, or 9? We say no, we didn't, because we checked box 1. And so under no, enter the amount from line 10 on line 12 and go to line 13. So here's line 12, where we entered that amount, the 5,000. If you complete line 11, enter the smaller of line 10 and line 12. All others, enter the amount from line 10. So we've got the 5,000 being here. We then go to 13. Enter the following pension, annuities, or disability income that you and your spouse, if filing jointly, received. We're going to say we have the 500, and that's going to be the non-taxable part of the Social Security. So we got Social Security benefits. That's going to be this 500. Line C, add lines 13A through 13B, which of course is the 500. We'll go to line 14, enter the amount from 1040 line 7, 15,000. That's the adjusted gross income. So 1040, just to check that out. Line 7, 15,000. That's the AGI, adjusted gross income. Back to our form, page 2, Schedule R, page 2. Then we have, if you checked in part 1, box 1 or 2, again, we checked box 1, we're going to put that 7,500, 7,500. Then we're going to subtract line 15 from line 14. If 0 or less, enter 0. In our case, we have the 15,000 minus the 7,500 gives us the 7,500. Line 17, enter 1/2 of line 16. So we got that 7,500, half of that, giving us the 3,750. And then 18, add lines 13C and 17. So here's 13C and 17, which gives us that 4,250. And then line 19, subtract line 18 from line 12. So we're going to go back out in the outer column. Line 12 was our initial amount, that 5,000. And then we're going to subtract out what we just calculated, 4,250 in line 18 to give us line 19, to subtract those two out, which is only 750 at this point. And then we're going to multiply line 19 times 0.15 or 15%. And that gives us the 113. So we've got 113 at this time. And then the tax limit is enter the amount from the credit limit worksheet in the instructions. So here's the credit limit worksheet. It's the 141 amount of tax from form 1040 line 11. So in other words, if we go to form 1040 line 11, we only have this much of a tax liability. So our credit typically can't be, that's going to be a limit typically. So if we go back over here, we're going to say, all right, page 2, it's going to be under that. And so that's going to be our credit, the 113. So you'll note that you could see kind of the limitations, the AGI limitation as you go through here, and the limitation with regards to the liability limitation, which greatly reduces the effectiveness or the amount of this credit. That credit then is going to be going to, if we read this, credit for elderly or disabled. Enter the smaller line 20 or 21. Also enter this amount and Schedule 3, Form 1040, line 54. So if we go to Schedule 3, there's our credit. If we go to the 1040, then we'll see that credit here as well, line 12, bringing our tax down by the 113 to 28 in this case.